Welcome to Your Money, Your Call. It's bonds versus equities. I'm Mark Todd from FIIG Securities. If you have any questions about the share market or the bond market, please give us a call on 1300 30 34 35, or you can email us on yourmoney@skynews.com.au. Now, joining me on the panel at the moment is Steve Lambert, who's the Executive General Manager at the NAB, and he looks after the global markets. We will have Roger Montgomery coming with us, but Roger's held up in the Sydney traffic, so he's got the disaster. He'll have to arrive late. How's your week been?
Yeah, it's been pretty busy, Mark. It's been been following. We had a few deals in the market this week, which closed yesterday and today, and just getting set up for next week. Really, it's been a short week.
So in terms of your work, mate, the capital markets for the viewers at home, it's more about going to the banks. You fund the bank itself, NAB, but NAB, there are people in the NAB that you also look. I think it's a good chance to go and borrow some money.
Yep.
We always hear about banks looking to borrow money, but it's also on behalf of other banks as well, isn't it? That would be true.
Yeah, so I guess the way we talk about it is the NAB is a large customer of my team, as well as we help other Australian customers as well as clients overseas raise long-term debt.
So a customer might be, and let's not talk specifics about that customer, but you could hear a Coles or a Woolies or big corporates will come to you and say, I need to borrow some money. We spoke about this through the week. It was interesting, there came a point in time where the corporates could borrow at the same rate as the banks, wasn't there?
Probably even cheaper. There was times there just after the GFC where it was definitely cheaper for the corporates to raise money than ourselves, even though their ratings may have been a notch or two lower.
So why is that?
Well, I guess at the heart of the 2008 through 2008, there was such uncertainty around the whole banking system globally that it became very difficult for banks for people to assess banks, which banks were in a good position, which ones weren't. And it just affected the whole industry. So a lot of people got out of banking debt and bonds, moved to the government, as well as moved to high-rated corporates.
So when we talk about moving into the sovereigns, that's the flight to safety, isn't it? That's what everyone's saying.
Exactly.
Greek safety? I mean, flight. How does that play out eventually? Did that become, as a consequence of governments not understanding capital markets to some extent, I'm going to bail you out, I'm going to bail everyone else out, and that then meant the sovereigns changed in the risk profile, didn't it?
Yeah, so it's fair to say that at the heart of the problem at the GFC was a problem sitting within parts of the banking system globally.
Yeah.
And the Aussie banks and the Canadian banks sort of went through that whole process really well, and we're probably still the only AA rated banks globally. But in other parts, Europe in particular, but also in the US, where the system was hit very hard, ultimately that problem in the banking system really got transferred to a different type of problem with the sovereigns.
I remember I was in Europe, and I went to Ireland, and it was literally that weekend where they had the chief executive of one of the Irish banks shaking his fist saying, give me the money as well, because they gave it to the banks and the government then gave it to 3 of the banks. That's like children.
Yeah.
And clearly that passed on to the Irish problem, so that the Irish taxpayer suffers. But we don't have that here, did we? We didn't have that.
No, so really the Aussie banks were, came through the problems in 2008 really well, both certainly relatively on a global standard, but absolutely as well. I think the other thing to remember is a lot of the European governments didn't go into the GFC in the same sort of fiscal position that we went into here in Australia. So the opportunity, the levers that the government had to move through that 2008 and 2009 was significantly better in Australia than they were offshore.
We're on tape, and you're saying that the government, which was the Labor government, did something well. It was interesting, isn't it? I was looking at it from afar thinking, gee, they've done a really good job. Yet no one would believe that. I mean, I think that's a consequence of the way they were able to articulate it. They gave the banks some support, didn't they, in the form of the guarantees?
Yeah, the financial guarantees.
When you have
which was really important for accessing global capital markets at that time. It was, it's very important for Australian banks to be able to access overseas capital.
Yeah.
Equally as important to access domestic capital, of course. But historically, the nature of of Australia is as because we run current account deficits, we need to borrow money from overseas. We need a current account surplus.
I do want to talk to you about that. That's a really interesting point. But the thing I wanted to just start with, what was it like to go to the international investors and say to them, I'm the National Australia Bank, or I'm on behalf of another bank? How did they react to you? Was it something that they said, well, we've done a lot of work with you, we know you see, we trust your analysis, here's the money? Or did they say, it's a whole new ball?
I think there was, honestly, during that period, there was both situations. There was situations at the worst cases, just post the Lehman's collapse, where no one was sure where was the risk sitting in the banking system, and there was a lot of concern globally, even amongst very large banks. But broadly, the Aussie banks, because of the nature of their long-term borrowing, their name, if you like, their ratings in the international markets, could access funds. But at the worst days and the worst weeks and months, that was why the guarantee ended up becoming very important.
And when you go and pitch to somebody, do you then just say, look, here's the guarantee, there's my backstop, it's the sovereign, or did they already know that, so you didn't have to talk about it? They still want to know your underlying business, or it was?
Yeah, no, it was still fundamentally around the underlying business, but probably at the worst times, it was it was better probably not to enter into the market. It was looking at more in the domestic market, and where the story was well understood, where we weren't experiencing the same problems that they were experiencing in the US or in Europe. But Asia generally went through the period pretty well.
Yeah.
And Australia always has a very strong relationship, not just trade in physical goods, but also in capital with the major financial centres in Asia. So what we've seen post the GFC in terms of who funds Australian corporates, of course the Australian majors are the largest part of that, but the Asian institutions are becoming relatively more important as a source of capital. And
give me an example. When I talk to the viewers about some of the institutions, you think of PIMCO and that sort of stuff. But what are the large Asian, without trying to take your customers away? But do you know what I mean? Like, but is it like us, where it's industry super funds, or is it more private?
No, it's quite a different market, really. The way I think about Asia, I look at Japan as a separate entity, and then ex-Japan Asia. Yeah. So in Japan, there is some similarities with our model. It's generally pension funds, very large pension funds, large insurance companies, and large banks. Banks themselves, of course, are large lenders to other banks for various reasons. The rest of Asia, private banks are very important, but the banking system generally, and of course central banks. There's been a lot of discussion, as the viewers would know, around the amount of money in the central banking systems through the region, and as well as what they call sovereign wealth funds, which are very important in Asia.
And what's a sovereign wealth fund?
Yeah, it's a hard one. I'm not sure about the direct definition, Mark, but it's basically a government-owned fund. That's been set up. I guess by some definition, the future fund would be a definition.
So we've taken Australian tax receipts, we've put it in, we've said this will fund the future employee superannuation for government employees, and so we've got this fund, and you need to go and invest money. And Mr. Murray, you're a custodian, get a team together and start spending some money.
Yeah, and different countries would have a different rationale for setting up that sovereign wealth fund. In some countries, it could be because they've got a lot of oil wealth. And they know that oil wealth will one day run out, so they want to set themselves up to have ongoing.
Because Norway is somebody that's got a massive.
That's the one I was thinking of.
They're the one that they came in very early. Those Norwegians are very smart. They got in and they created it very early, and it's just got the compounding effect, hasn't it? And it makes them so very powerful.
Yeah, absolutely.
Which I suppose if we talk about, without wanting to pour anything on the Clayton's reforms the government's suggesting on superannuation, it is. Our industry superannuation, or our superannuation policy, is the medicine for all ills, isn't it? It just the rate that it's growing is a massive amount of money that can be tapped in different ways, and I guess the key for the banks is that how do you tap that money to fund the internal organisation of the banks?
That's a good question, and it's one that's not particularly well understood, I think, domestically. I mean, the reality is in the Australian banking system is for every dollar we lend out, we need to raise that dollar in some form. And now, I guess in the textbooks, it looks like we raise that money in deposits.
Correct.
From retail, from our clients, and then we on-lend it. But the practical reality is, for every dollar we lend out, we're probably only raising around 70 cents or so
in deposits.
So the remainder comes from our equity base and then from raising money in wholesale markets.
Yeah.
Those wholesale markets could be domestically, which is around how do we raise money from super funds, but it could also be from international investors.
Now we've got a caller. Our first caller for tonight is Michael from Canberra. Hello, Michael. How can we help you?
Hi, Mark. Can you hear me okay?
I'm sorry, it's very faint. I can't hear what Michael's saying.
Hello.
Yeah, hi, Michael. I can hear.
Oh,
okay,
good.
Great. Thanks for taking my call. Good evening, Mark and panel. Enjoy your program. Ingrid from Business Night interviews a chap from London called Roger Nightingale from the London Stock Exchange, I believe. He's quite a bear as far as the forecast for Europe and, if not the world, forecasting recession and possibly depression. Where will our equities, our bonds, our fixed interest head if that should occur?
In depressions and in poor times. Well, we've sort of got the experience. 2008. What happens? It's the flight to safety, isn't it? Essentially, people will make mistakes within it, but they'll go to the government debt markets. They'll go to where they'll get returns on their money in their currency. That's a fair way to assess it, isn't it?
Yeah, I think typically the answer is to re-stimulate an economy. Interest rates typically need to fall.
Yep.
And governments then look to through fiscal means to try to stimulate the economy through their own spending. That would be the typical sort of approach. I'm not sure if that goes to Michael's question, or his question was.
Well, I suppose his question is there going to be a depression? And I don't think there's going to be one tonight. But clearly there's always questions around. If we look at our economy seems quite solid. It seems very well balanced. We've got a currency that is too high as far as the RBA is concerned, but it's not really inclined to do anything because it wants us to retool around a higher number, doesn't it? It wants us to get used to these high currencies and therefore just move on. But I think we seem to be doing that. Whether it just be the mining sector, the government talks about the next sector to take over after the mining sector. They don't actually tell you what it is. But I guess we think it's construction. Would that be the one that we would look at?
Well, I think that's the challenge domestically, is that whilst investment from mining is still continuing at a very high rate, it's just not growing at that. So it's a rate of growth story rather than an absolute level issue.
That's right.
And really the question is, to the extent that we know that the rate of growth in mining investment is slowing, what will come in to stimulate? What's that next industry, if you like, or segment? And it is a little bit difficult to see. There's probably some signs that may be construction, but it is difficult to see. And whilst it may be other industries may grow, will they grow enough to take up the slack?
And I suppose for the viewers at home, the key for the RBA is getting the spread of it, the diversity of that growth. In other words, if you grow a sector that's, say, tourism, it doesn't have a great enough multiplier effect in the economy. It doesn't mean that you get the plumber, the builder, the carpenter. You need to have that multiplier effect when you're looking at it from an RBA perspective, aren't you?
Yeah, I think at the end of the day, the RBA, part of their mandate is obviously around inflation, and that's a key factor. And then how does that play out? And right at the moment, they'd be pretty happy with the way things are sitting. I mean, the inflation looks like it's the lower end of their bound, and they'd be pretty comfortable. And we saw some decent data this week, which would also probably suggest that they think they've probably got it pretty well right.
They've got a great set of numbers. Look, we'll go to a break and we'll come back and talk to you about a great set of numbers with some. Welcome back to Your Money, Your Call. My name is Mark Todd from FIIG Securities, and tonight I'm joined by Stephen Lambert, who is a General Manager of Global Markets at the NAB, and Roger Montgomery is still in the ether. Roger, we're missing. Roger, call home. Now, I wanted to start with an email, if you don't mind. We've got an email here from Barry from Austinville, so we'll take that email. The email is, I have a $2 million term deposit coming due, it was paying 8%. When will term deposits get back to that rate? And in the meantime, how should I invest this money? If you want to be part of the show, call us on 1300 30 34 35, or you can email us. The email is yourmoney@skynews.com.au. Well, Barry's good that he's got $2 million. That's a good thing.
That's excellent. Yeah, well done, Barry.
I remember Suncorp were offering 8%. I know that in the middle of the GFC, so he's obviously had a long-term...
Yeah, I was going to say that's you won't be getting that at the moment. I would have thought, Barry.
That's an understatement. In terms of, he's got two parts to his question. When will it be getting back there? I don't think that's going to be happening for quite a while. I think global markets are not going to allow interest rates to go up.
Yeah, I think more around interest rates rather than a specific product. I mean, we've seen this week interest rates on hold domestically, and it's very difficult to see a situation where rates, general level of interest rates anywhere in the world going up.
I mean, I think the US is driving the whole conversation, and they clearly come out every week saying we are not going to do anything. We are going to accommodate. It's going to stay where it is, which is very low. Yeah. So to Barry, your first point, it won't be at 8% for quite a while. In terms of a $2 million portfolio, we don't have enough information at this point in time to give you the right advice. But we often look at FIIG, we have a metric that says you should invest around your age. So if you were in 60, you should look to put 60% into fixed income. Within that fixed income piece, we'd like to segment the piece around your inflation, floating rate, fixed rate. It's the Rumsfeld portfolio. It's you invest because you don't know anything. You don't know what you don't know, and so I think it balances around that, and trying to minimise some of the volatility, because the equity rally. I don't know what you think, but it seems to be it's the four banks, it's Telstra. It hasn't really trickled out yet, has it? Yeah,
it's across a fairly narrow base at this point. I think that's right.
We've got a graphic that we'd like to show you, and it's around what's actually happening. This graphic highlights the fact that when you think of a term deposit, that is one of the safest assets in the bank. It's you would know yourself because you're out there issuing either covered bonds or senior debt, and we can talk about that in a second. But people are moving from a very safe asset and a term deposit. CBA paid us 8% on Suncorp, and going into the equity, and I don't know that they necessarily appreciate the difference in credit. Is that broad generalisation feel right to you?
I think broadly, what I would say is that I think the level of investor education around fixed income is still very low, particularly as an asset class, and that's why we're very committed within NAB to really try to build out that investor education around the asset class. I'd agree with that comment. I think it's just people are truthfully typically not as attuned to the different nuances within the asset class.
One of the things with this show is that we don't actually try and promote any particular, we'll have a bond of the week every so often and that sort of stuff, but the education is the driving thesis.
Yeah, absolutely.
How do you go about educating the investor base? And I don't mean the institutions that you'd be talking to. I mean, how do you talk about that?
Yeah, that's a really good question, and it's one that we're grappling with at the moment, and I think it's one that the broader industry needs to grapple with. So we've been working a lot recently with various parts of government, to start a debate around the need for a corporate bond market domestically, talking around accessibility, transparency around the market, and then broader education. So we've done a lot of work with people like the Centre of Financial Studies out of Melbourne around base level data around the need for a bond market and what is a bond, and even simple data like that. And the more people to start the debate and get in the debate and start talking about it, we start getting the information out of you. Shows like this, very important for that.
So why do I need bonds? If there's a theme, what's the first thing that you're going to say? The reason you need bonds is for why?
Well, it depends if you're an investor or a borrower. Really, I think they're two different stories, but I think they are quite related. On the investment side, I think one of the big issues that we're facing the next few years is what was called sequencing risk. Which is this whole point that I think many people have got in the last few years, that as you're heading into retirement. And we know that as a country we've got this large number of people coming into retirement.
We don't
the next
call
few
them
years.
rumps.
Don't call it rumps.
We've stopped calling them rumps. That was back in the old days.
Bad word, Steve. But we've got a lot of people moving into retirement, and a hit on your capital at a period moving into retirement, we know has major flow-on impacts. And I guess that's been called sequencing risk, around thinking around that maybe over a 30-year period you can take some ups and downs, but when you take those ups and downs is very, very important.
Yep.
And it goes to your point you said earlier around your age and your age analogy, which I haven't heard before. It's an interesting one. And that's that it's trying to remove some volatility of those earning streams as you approach a period when you don't want that volatility.
I can't tell you how many times I've had customers come in and they've said that we've retired, we're self-managed super funds that they grow at, there's 500,000, they grow at 30,000 a month. And the GFC meant that they turned around and said, this is harder than I thought it was going to be. And the impact of trying to get up to speed from an education point of view, they come to us and we're looking to educate and get that right. But what it does is the ripple effect. It's not just that they found it hard. This is what I find. It's their partner said, hang on, this was supposed to be easy. Our retirement isn't the way we think it's going to be.
Yeah.
Clearly, Challenger got it right with some of that marketing, didn't they? That look away in the far distance saying, the volatility of the share market. And I think it's true that if you can get an asset that produces 6.5% returns and you've taken some of that volatility, you tend to have a better retirement, I'd imagine.
Yeah, I
Not
think
that I'm looking to retire, because obviously I'm a very young guy.
well, both of us.
That's right,
both of us, mate. But I think the whole point is around volatility, really. I think that it goes to your point. You never know what's going to happen in the future. So it's a question of what is a balanced portfolio?
Yeah.
And I think a balanced portfolio includes equities and growth assets as well as fixed income. And as a country, we typically have always been overweight. And in fact, we've seen data that in the OECD we're probably the most overweight.
The most overweight in equities.
In equities,
And there is. I wouldn't say that you want to be too judgmental of the equity market, because that's where they've come from, and it's not. I think the problem with the equity market is they believe all in the one church of equities. They don't believe in anything else.
Yeah.
And I think if you were to say right now what a balanced portfolio is, it is completely different to what it was 5 years ago.
Yeah, that's true.
70% equities, 30% cash, and there was no fixed income.
Yeah.
One of the things I often think is that the problem for the fixed income market is getting the investor base, the retirees, to understand that they have to invest for a long time, and they need to start taking some duration. They need to be able to say, a portion of my money needs to be away for 5 or 6 years.
Yeah.
And I find that's the hardest challenge, making people realise that they need to be invested and maybe changing some of their expectations. When you talk to the people that you're talking to about education of fixed income, 6% is a pretty good return. Do you find there's a lot of pushback? People say, the equity market can give me 10%, or NAB shares are offering 8, or whatever they are. Do you think that's a big pushback?
Well, I actually think the bigger issue is the market, are people like myself in the banks providing the right sort of choices at the moment? And by that I mean, is there enough product? If we provide enough education, is there enough accessibility into product currently? Or is it been, historically the fixed interest markets are focused on the institutional end of town?
Yep.
And they've been very well serviced. And really the issue is, how do we get many of the same sorts of products or similar products having it explained to a broader audience? And I think we're getting better as an industry, but I still think we've got a long way to go.
For the viewers at home, how does the institutional fixed income market work? Because they're used to having the ASX, I can log into a broker and see my market. How does the institutional market work?
Well, the institutional market is typically a telephone. It's still largely a telephone market. By that I mean it's over the counter. It's someone makes a phone call to a broker or a dealer.
Yep.
There is also more and more every year, more electronic trading taking place. But typically at the institutional end of town, they're fixed rate it's fixed rate product. People trade, if you like, relative to both futures and to government bonds.
Yep.
And
now that's not the market that you'd be anticipating that the retail participant will be involved in. So how do you see that corporate bond market going to the retail in 5 years' time or whenever? How would you imagine that will be? Part of the broker environment? I'll look up my stockbroker and see it, or what would you do?
Well, when I say
other than calling NAB, of course.
Yeah. Well, when I say by broker, I mean banks and who are making markets in these things. I think it will probably be in 5 and 10 years' time. I would hope that that it's as easy to purchase lumps of parcels of fixed income as it is to trade equities. I think that would be an aspiration.
And is that so? Are you marketing to the stockbrokers as well to say, look, you're an intermediary, you should have this for your clients, and even doing that? I mean, we do that, and we're getting some really good responses.
Yes.
What's the response coming out of that from your clients with the stockbrokers? Is it something they want?
Certainly, the stockbrokers have really. Probably because they have had a hard few years, obviously, in the equity side.
And deserved it.
I'll leave that one alone.
Okay,
so they have definitely become converts into fixed income over the last few years.
We love good converts.
Yeah, we do.
Now we're going to go to a break, but before we go to a break, we're going to do our speed round, and our speed round is for 30 seconds. Yep. You know the 4 questions. Leading with that, 2, 1, it's all yours.
Okay, where are the questions?
It's the cash. It's the 4 questions I asked you. It's where's the cash rate?
Yep.
Where will the you better start. You've got 20 seconds to go.
Okay. So cash rates. I think cash rates in a year's time will be up smalls.
Yep.
I don't think it'll be large. What's the next one?
Interest rates.
Interest rates.
Yeah.
Broadly
interest rates.
the same.
Equities. Currency.
Okay. Currency. I think Aussie US down. Probably below 100, maybe 98. Bond markets. Same story. Rates up small.
Welcome back to Your Money, Your Call, and tonight I have Steve Lambert, who's the Executive General Manager for Global Markets for the NAB, and Roger, we've worked out it's been a timing difference, so Roger's not going to be joining us, unfortunately, so we'll get Roger in another time. Let's chat about bank productivity. I know that everyone, we spoke about it just before the break, that everyone was aware of the dividends that the banks are getting, and we think that's where they've centralised a lot of their investments. What is it like at the moment in bank productivity? When I talk to some of the balance sheet guys, they say, "Oh, we've missed the productivity this month." I said, "What's that mean?" We all kept our job. So how is bank productivity reflected with you guys at the NAB? Is it a constant theme?
Okay, so I guess you can think about that as a team leader as well as individually. But I mean, for me, at a bigger picture, the productivity things that we sort of look at is through technology and through the investments in technology, how you can sort of do more with the same. Really, that's largely what it's about. And as a team leader, every year we're always trying to innovate, like bring in new products or look at accessing different markets and trying to create better products and services to our clients. And but you try to do it with a broadly similar base of people and skill sets.
Because I suppose to some extent the idea is that the credit market, the credit growth is harder, isn't it?
Yeah, absolutely.
That's clearly, whereas you could lend to people all the tea in China, you can't really do that now. So, and not being able to lend as much money, you need to be able to get that productivity because the investor base out there have agreed that we want that dividend.
Yeah, and they've given the banks a certain amount of capital to use to generate a return. So it is around being very conscious around your cost to deliver and your cost of production, and to think around what other things can you do that adds value to the clients.
So productivity is around also using your balance sheet. So or not the NABs, but all banks need to use their balance sheet in a more meaningful way.
Yep.
So you're the guy that gets the money for the banks. Not all, but you know what I mean. That's a theme about bank money. So how do you decide where you should issue debt? In other words, the viewers at home would be familiar with hybrids.
Oh yeah.
That's a form of debt. So you'd issue hybrids. They may not be aware of covered bonds, but you know what I mean. They have subordinated debt. How do you work out what the bank should issue? who is your customer? How do you work that out?
Yeah, so within our bank, within NAB, most banks would have a treasurer and asset liability committee that sort of determines broadly at the start of the year how much is going to need to be borrowed over the course of the year to have enough money to lend out to clients, and so that's sort of determined largely at the start of the year in a broad sense. But the key thing with the banks is the banks have access, because of our ratings and because of the various types of legal programs we have set up. We've got access to multiple markets all around the world, different types of markets. Some of them are short-dated markets. Could be borrowing money for 1 month or 3 months or 6 months. They could be long-dated markets, 10 years, 12 years, 15 years. Could be hybrid markets, covered bonds, securitization. There's a whole range of raft of things that banks have access to. And really, it comes down to multiple. It's not a simple decision, but the decision would be based around, of all those different alternatives, which one would give me the cheaper cost of funding, which one would perhaps give me a tenor that I'm after. Quite often the banks, you have heard discussions around banks looking to borrow longer. The regulatory authorities would love us to borrow longer rather than borrow short. So it's forever a changing mix of things. And the other thing, you don't always just borrow from the one market. You want to get your name known globally, internationally.
So you spread that risk around.
Absolutely, you spread that around. Multiple currencies, all those sorts of things.
Is it true though that essentially the banks that we have in Australia are very simple animals, aren't they? It's not as if you're an AIG that has all these derivatives, weapons of mass destruction, that sort of stuff. So essentially, it's a mortgage business. It's
I think 55 or 60% of our balance sheet would be based around mortgages and small and medium company loans. Probably.
Right. So I've got 2 questions there. In the mortgages, I don't know what the average tenor is, but let's say it's 7 years. People turn over their house, maybe that's on average 7 years, or whatever it might be. Do you tend to match the borrowings around that profile? If a man in the street or a woman in the street has a mortgage, is the bank looking at the length of the mortgage? Because that's sort of where people got into trouble, wasn't it? They lent mortgages in the GFC, I mean. Do you try and now match that borrowings?
So this gets really complicated, but broadly across the whole balance sheet, we have various different types of assets, and each of those would have different maturities, both legal maturities, because a lot of mortgages, of course, are 25 years legally.
That's right.
And whereas the experience would show that perhaps it's 7 years or 8 years on average across, but there's going to be a long tail. There'll always be a tail. And at the other hand, you also have your liabilities. Now, for a bank, a liability is our deposits as well as term debt raisings. So we have controls around by buckets, if you like, around when the assets mature, when the liabilities mature, the sort of mismatches you have. And they're pretty strict. And so therefore, largely, you are trying to match in a broad sense the assets and the liabilities. There is mismatch, of course. Because that's one of the roles of a bank. One of the roles of a bank is to manage that mismatch for society.
We've spoken about mortgages. We know that the US, it was all about no doc, low doc, crap. People were just filling in false documents. That wasn't really the case here, was it?
No, not at all. No, in fact, we've had I'd still say Australian mortgages are, if not the best in the world, they're certainly in the top couple of countries in the world.
I mean, I've noticed that for some of our clients, I mean, they look to invest in mortgages. They like the return. I looked at today. I looked at the Reds. Now, Reds is
Bank of
Queensland. And I looked at the 2007 performance, and I looked at the total arrears. So that for the folks at home, the people who hadn't paid their money, it was less than 4%. For the 2007 mortgage. This is a really good result. And one of the things I noticed was that with the lower interest rate environment and the high level of employment that we have in the country, people were still aware of the GFC, so what they did was they paid off more of their mortgage. That's a trend that you would be seeing, I'd imagine. I think that's true. We do a lot with various bank and non-bank mortgage originators. So we do a lot of business with that group, and we follow this very closely. And you're absolutely right.
the extent that people could make an extra payment on the mortgage, that was pretty common.
We have an email from Sarah and Andrew. The email is, given the importance of fixed income in a balanced portfolio, what can the government or the market do to assist in developing the Australian corporate bond market? Other than engaging you, what do you think, Steve? What can the government do? I mean, I know that they jawbone it. There seems to be a lot of people involved in the conversation. Government or whatever persuasion we have, because it won't have been developed by September.
Yeah.
What can the government, without looking at politics, what can it do?
Well, I think a lot of it. I think the big point is that it's not just the government. It's the government and the industry and the borrowers and the investors need to sort of think around what will work. Okay, so and there's no easy, quick fix. But there is definitely some regulatory elements of this in terms of simplifying certain processes, and a lot of that's largely either been done or it's in the process of getting done. A lot of it, there's definitely a large role for elements of government to sort of work with industry in terms of this whole piece of education that we talked about earlier.
Yeah.
And again, a lot of that is getting done currently. But I think the debate around the need for a corporate bond market to allow borrowers, particularly corporate borrowers, to diversify their funding away, or at least not just have all of it in the one box being the banks, is important. And on the other side of it, to provide alternative investment structures for our retirees and for other investors is equally as important.
I was really surprised when Murray, Keating, Henry all came out at about the same hour, it was the same week, and said, we need to have a bond market. People need to have bonds in their portfolio. I was surprised by the level of aggression that came back. Different organisations saying there's absolutely, crazy, this is the right time to be buying equities, it's going to go. And I sort of think that's missing the point. I think the point is that, like fresh air, you need to have it. So you need to have a bond market for two different reasons. A, it helps the investor base just to stop that volatility. But B, if we are to grow as a country, you need to be able to tap into those resources to keep some long-term funding for the corporations.
Oh, absolutely. Yeah, and I think the other side is that over time, there is a bit of a debate around, are banks the natural holders of long-term borrowings and long-term debt and providing long-term funding, and it's getting harder. It's getting harder for banks to affect maturity transformation, which basically means to lend long. To
lend for the length.
And yet that's what many borrowers are crying out for.
Why is that getting harder?
Well, I think it's multiple reasons. One of the key things are some of the regulatory impacts that have happened. Basel III, that is probably one of the major reasons. Another is around the way banks think around their return criteria. It could very well be that it could be there are cheaper sources of long-term funding perhaps than the bank market. Because
the banks have got to get a return. We go back to that capital. They need to get that, because the shareholders need to get that return. And so do you see that means that banks, not happening on Monday, but potentially over time, get to be smaller because of that, if that market moves away from them a little bit?
I think it's more around, I'd see it slightly differently. I think it's that the banks have a real expertise around credit assessment and putting deals together, transactions together, bringing parties together to make things happen. And I don't think we'll ever get to a situation. I don't think anyone wants a situation where banks are not lending money. I mean, the key is the banks will still have a very, very big part to play in lending money. Right, this is not about the bond market taking over from the banks. It's about the banks and the bond market working together, utilising the skills of both, really.
Great. Look, that's very interesting. We'll talk about some of that capital flows after the break. We'll leave it there at the moment. We'll go for a quick break. But if you have any questions on the bond market, please pick up the phone, call us on 1300 30 34 35, or email us at yourmoney@skynews.com.au. Welcome back to Your Money, Your Call. I'm Mark Todd from FIIG Securities, and joining me is Steve Lambert from the NAB. And we have a caller first up. It's John from Brisbane. Hello, John. How are you?
Good evening. Very well, thank you.
How can we help you?
I wonder if the bond market could be extended and structured to do infrastructure for all of our cities. We've had tunnels and roads and things in Brisbane, as we all know, which have been a difficult thing to fund. But the long-term bond market, in my view, would be the right way to structure our future infrastructure.
Couldn't agree more.
Yeah,
I mean, that's essentially what, John from Brisbane is not a planted call. It's the call that is absolutely on the money. What do you think? Do you want to lead off?
Oh, no, you're absolutely right, John. I mean, it is a natural. It's typically the style of hopefully stable cash flow, which is very suitable for looking at with bonds. And I can just even think in the last year, there are transactions that we've completed which we've gone into bond markets. Typically overseas, though, I would have to say, which
the Canadians love it.
Canadians love it, the Americans love it, the American insurance companies love it, and the challenge sometimes is structuring these sorts of deals. Whilst everyone loves infrastructure, sometimes the first tunnel that's built is not necessarily
with the flow of cars.
With the patronage risk, is what's called patronage risk. That's an issue, but structured well, the infrastructure is easy. It's a very good asset class for the bond markets, and that is also why historically infrastructure is funded by loans and in the bank market. We like that asset class.
I can't begin to tell how much at FIIG we do with infrastructure. It's the jewel in the crown. Sydney Airport's inflation-linked bonds trade at about 4.4 roughly plus inflation. So if you're looking at over 6% for a 30-year, 2030 maturity, but it's the schools, it's GEM schools,
it's hospitals,
County Court of Victoria. It's all these things that says, this will be here as a hospital. It will be here for a very long time. It needs some very stable funding, and the government looks to support health or whatever it might be. It's such an easy sell. But I feel like the debt markets, by the way, now I don't mean this opposition, I just mean all oppositions, say that there shouldn't be any bonds. The government shouldn't issue any debt. That seems to be a natural impediment, as if debt's got a bad name. Is that how you'd read it?
Well, I think there's a few things. I think one of the things you have to recognise with infrastructure, there's one type of risk when something's being built. Typically bankers would call that construction risk, and how you manage that process. And then you have what would potentially be the cash flows coming from then a stable asset, which then is very doable in a bond form.
We call it low operational risk.
Low operational risk.
Because they've handed the product.
It's working, right?
It's working. Defence housing, it's gone back, the defence building's built.
But for the government's point of view, I mean, one of the challenges they have, there is a distinction between funding and financing. So funding is actually raising the money in a debt form, but the financing is ultimately around what is the repayment of that bond? What is the payment of that coupon? And will there be enough money coming out of the asset to repay the asset, or do you rely on a charge in some form to the government or to another entity to make that payment? And that's sometimes a real issue. Because
let's say the government wants a ring road or wants something. Are you saying that we're relying on the cars being charged the fee, but the government overlays it and says, in the event there's 50 cars less, we'll pay the $2 per car? I guess I'm saying is that it depends on the nature of the infrastructure and the transaction, and if in that case it did require a top up from the government, it's like anything. How will the government then fund that? So it's that government financing issue is sometimes a constraint. But the general approach is a good one. There's a general approach is around why couldn't we fund infrastructure, long-dated infrastructure, with long-dated, say, superannuation or other assets in Australia? But it's been such it's an obvious solution, in that the Canadians do it. You see it, Ontario teachers, all these people look to come in and buy these things that'll go for 30 or 40 years. I don't know if you saw in the paper today, the IFM, the money that's gone in the last, I think they're a $44 billion organisation. In the last 9 months, they've had $2 billion just for infrastructure.
Yeah.
So, and it's mainly been from offshore. People giving this to a fund manager saying, go and find assets that last for years and years and years.
Yeah. And quite often that's, a lot of the infrastructure investment is in equity. So it's equity infrastructure. And of course,
and what do you mean by that for the people at home? What do you mean by an equity infrastructure?
An equity infrastructure would be the initial investment in the infrastructure project. So typically most infrastructure transactions would have debt and equity in there.
Yep.
So it's typically sponsorship capital versus the debt capital, which is provided typically by banks in the construction phase and then later on in the bond market.
We've only got a couple of minutes to go, and I just wanted to get your thoughts on some of the macro issues. We you know, Korea, you know, that seems to be such a volatile and crazy, you know, experience. What are your worries at the moment from global markets? If it's not Korea, sequester, you know, what are you seeing at the moment? What are you worried about?
Well, to be honest, I probably haven't changed much in the last 6 to 9 months around, you know, what I thought. You know, I think 2013 is sort of playing out, unfortunately, in some respects, the way I thought it would. And for me, it was, I thought geopolitical risk in a general sense, that was what I was probably one of the key things I was worried about during the course of this year. And by that I mean, you know, I wouldn't say I thought, oh well, Korea is going to be a problem, or Syria was going to be a problem, or the next, you know, but it was just this general sense that I think that the world there's still a lot of things out there which could easily blow up and
literally.
Well, in many cases, and come at a time that you may not expect. So that was one thing. I guess I still think a lot about Europe, and it's more around global growth, really. I mean, the other big thing for me that I think about is where is global growth going to come from? And we sort of touched on it a little bit in Australia with the mining investment and what was going to take the place. But think about it another way: which countries are going to grow that are really going to add to growth globally, and how are we positioned to deal into that? And the great thing is, and one of the reasons I think Australia is doing quite well, is we are pretty well levered into those areas that, you know.
So the Asian growth.
Good. Asian growth, absolutely. Be it India, be it China.
Yeah, we're in that position.
And I think the US is actually looking quite strong. I feel better about the US than certainly over the last couple of years.
I would have agreed 100% on the US, except the sequester. That is such a disaster. And what it is, it's a slow leaking disaster, and that's the problem. I have a real concern around the fact that we're going to get some jobs numbers tonight. If you followed any of the charts, any of the numbers, it just looks like the confidence is just leaking. Obama is taking a 5% pay cut in line with all the furloughed employees of the government. And it's not clear to me yet, but one concern I'd have is the Republicans would say, this worked, we're really happy with this, because they want to have that sort of burn it to the ground and rebuild an American environment. And I believe that they did really well. The economy of America has done really well in adapting. But this thing just seems to be such a crazy drag. They're self-emulating. They're just blowing themselves up.
I understand that perspective. I guess I would look at that, you know, the underlying economy, the noise around different events occurring, but the underlying economy looks okay.
We'll end on that good news. So, Steve, thank you very much for arriving and spending the hour. Roger unfortunately got caught. It was the wrong time for Roger. We had a bit of a mix-up there, so we apologise to Roger in advance. He'll be here in the next couple of weeks. Thank you very much for joining us on a wet week. I'm Mark Todd from FIIG Securities. Have a great weekend. All the very best.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.